Hey guys, and welcome back to the channel. Today we'll be breaking down UPS's Q1 2026 earnings. And this is kind of like a big one, especially with what UPS has been going through and is going through at the minute with the largest restructure in history. The stock is sitting at near multi-year lows, and investors are asking the same question. Is this a turnaround opportunity or still a value trap? In this video, we're going to be slide by slide through the numbers, what they are saying in the strategy, is the dividend still okay, the outlook for 2026, and by the end, we'll hopefully know exactly what to watch for in Q2 and whether UPS is a buy, hold, or avoid. Let's get into it. So as you can see on the screen, the key stats for UPS, the stock trades roughly around $103 with a market cap of roughly £88 billion. The UPS is a giant, over 460,000 employees roughly, and operations in more than 220 countries, and a long history of dominating the global logistics space. And the dividend is a big part of the investment case. It has 16 years of growth, roughly 10% 5-year dividend growth, and a 6% yield. But a high yield can be a warning sign if the business is under pressure. So later in the video, we'll see if what they say about the dividend and see if it's actually safe. Because especially it's got 10% a year 5-year growth, but it actually grew only 0.4% last year. So what actually happened in this quarter? Well, UPS ended 2026 in the middle of a massive transformation, and Q1 was the paying quarter. Revenue came in at 21.2 billion, operating margin at roughly 6%, and EPS at $1.02. But these headline numbers don't tell the real story. UPS had to execute several major strategical actions at once, walking away from low margin Amazon volume, reconfiguring the US network, reducing workforce layers, making sure that they're getting rid of facilities that aren't really working out, and resetting the cost structure for the world with lower volumes. And of course, good old Carol has called Q1 a critical transitional period, meaning that this quarter was intentionally messy so the rest of the year can improve. So basically, in other words, UPS intentionally took a hit now so the rest of the year can look better. But what is the segments looking like? Well, on the screen, we'll be able to see the US domestic segments, international, and supply chains. And international is highlighted for a reason, because that is the one that increased by 3.8%. That is right. International is one of the strongest parts of UPS right now. Revenue per piece is up, margins are healthy, and the segment is effectively carrying the company while domestic goes through its reset. And domestic is where the pain is. Weak margins, low density, and the impact of walking away from Amazon volume, and the supply chain is mixed too. Revenue has declined, but profitability is slowly improving because they are lapping last year's charges. The big takeaway, though, is international is stable and improving, but domestic is the turnaround story, and the supply chain is slowly improving. So, the turnaround strategy. So, I've highlighted a few bits from the earnings report. Now, this is the heart of the UPS story. UPS is executing one of the largest restructures in history. And, of course, the first pillar is the network reconfiguration, also called the network of the future. UPS is redesigning its entire US network, automating hubs, doing its operations, closing efficient buildings, reducing vehicles and aircraft, and rebuilding the processes from the ground up. The second pillar is efficiency reimagined, removing legacy efficiencies, reducing management layers, and improving cost per piece. And the key number here is cost savings. UPS delivered $600 million in Q1 and is targeting $3 billion for the full year. This is the number investors should watch closely, because cost savings directly drive margin expansion. And of course, the transformation costs will be heavy in 2026, between 1.3 to 1.5 billion, with 1.2 billion tied to driver choice program. But so far, the total cost of 599 million, and the program ends in 2027. And unfortunately, there weren't really much to cover on the dividends in terms of the earnings reports in Q1. They were brief, and the O'Brien invite just covered over it. But UPS paid $1.4 billion in dividends in Q1. Even though this is a recent quarter, the dividend remains supported by long-term cash generation and cost-saving program. Now, of course, the capex was slowed down by 0.6 billion, which leaves room for dividends even in a low-margin quarter. However, the cost savings will boost future cash flow, with 600 million already delivered, with 3 billion expected for the full year. The management reaffirmed full-year guidance, including margin expansion, and the companies that don't reaffirm guidance unless they are confident. So is Carol trying to tell us something here? And historically, UPS tries to protect its dividend because they've grown it for 16 years straight, even through tough cycles. But this is the thing. Even though they're thinking that they're going to have revenue at 89.7 billion and non-GAAP adjusted operating margin of approximately 9.6, they're expecting their capital expenditures to be around 3 billion and their dividend payments of about 5.4. So that's roughly $8 billion going to be coming straight out of the company. 8 billion. So, depending on what they had in free cash flow left over, this could be still a tight squeeze. But like I say, there weren't really much to judge on it. There weren't really much about the free cash flow. It was just kind of briefly over the transformational period. But as we mentioned, they did reaffirm its full year 2026 targets. Revenue at 89.7 billion, like we've said, adjusted margin at 9.6, the capex of 3 billion, and the dividends of 5.4. Reaffirming guidance after this weak quarter is probably the strongest signal yet. It means management believes cost savings will accelerate, domestic margins will recover, international strength will continue, and the free cash flow will remain strong. However, this is only arguably the most bullish part of the entire report. And even though the free cash flow could probably just about cover the dividends, that is why I highlighted it, as it hopefully needs to remain strong. Because it's got to. If they want to keep this dividend, they need to have the free cash flow trying to be as strong as possible. But so, what do we need to watch in Q2 then? Well, Q2 is the proof quarter. So this is what we need to watch. So we need to make sure that domestic volume stabilization. UPS had declined to where expected in Q1, but Q2 it needs to try and show some flattening out. If volume keeps falling, margins will stay under pressure. And because of that, domestic margin needs improvement. So the Q1 domestic margin was 3.6 or roughly 4% adjusted. Q2 needs to move towards the 6.8% range UPS historically targets. Cost saving acceleration. UPS delivered 600 million in Q1. Q2 should show a step up as the network redesign scales. And of course, as we mentioned, the free cash flow trend. Now, all I could gather was the Q1 free cash flow was strong enough to cover dividends. So that would be roughly 1.28 billion. That was the only piece of information that I could find online. Now, I might have been looking in the wrong place, but if anybody who does cover stocks, please let me know in the description, because in the comments, because I want to try and make the videos as best as possible, and I also want to learn myself when the earnings report isn't the brilliant, where to find extra information. But Q2 needs to confirm that the trend supports the full year dividend expectation. If UPS hits these markers, the turnaround is on track, but if not, does the stock really stay in the value trap territory, or is it going to even fall even further? So the final verdict, and this is my two verdicts. If you are looking on why UPS is probably still a buy, or at least a hold in the portfolio, because I do actually hold UPS. For long-term investors who believe in the turnaround, Q1 is intentionally messy. UPS delivered nearly 600 million in cost savings, reaffirmed guidance, kept the dividend intact. All signs of the management confidence. Domestic margins are weak today, but the 3 billion cost saving program and the network resign gives UPS a clear path to recovery. At today's valuation, this market is pricing in permanent weakness, which creates upside if margins rebound. However, if you don't think it's going to be, then UPS could be in a void if you don't believe the turnaround will stick. Domestic margins are still extremely weak, volumes continue to decline, and if the costs remain heavy through 2026, the entire investment case depends on UPS hitting its cost-saving targets and restoring margin. And if they miss, the stock will stay in the value trap territory. Until domestic stabilizes and margins show real improvement, cautious investors may prefer to stay on the sidelines. But I hope you guys did enjoy, and that wraps up the UPS Q1 2026 earnings. And if you found this helpful, hit the like, hit the subscribe button, and comment down below telling me which stock you want me to break down next. And if you want to see any more deep dives like this, then of course check out the links in the description. Then I'll see you on the next one. Goodbye.